Measurement principles. All transactions are measured in terms of money. Only monetary transactions, only transactions which can be measured in monetary terms, which are measurable in terms of money, find their place in the books of account. That was one concept that we had discussed. Now, money but does not have a universal denomination. We have rupee, there is dollar, there is yen, there may be mark, etc., etc., etc. Also, the value of the rupee when expressed in dollar is not the same each day. Today 60 rupees may make $1, tomorrow it may be 61 rupees and the day after it may be 59 rupees. And one more thing, normally there is inflation, that there is a rise in prices, and money today is always more valuable than money tomorrow. If I have rupees 1000 today, it may not be the same as 1000 rupees got at the end of a year. Because let us say there is an interest element. Had I deposited this 1000 rupees, I might have got a 10% interest, and therefore the value of this 1000 rupees would not be 1000, it would be 1000 plus 100, 1100. So a rupee today, money today is always considered to be more valuable than money tomorrow. Measurement basis. There are 4 accepted valuation principles. In accounting, so far we discussed that everything is recorded at the historical cost or actual cost. But accounting as a field, as a subject, is also evolving. There are other measurement bases and we will quickly go through them. Though usually as of now we are still using the historical cost, which is nothing but actual cost. So what are the accepted valuation principles? One is the historical cost or the actual cost. This is one. 2, the current cost. What is current cost? If today we acquire the same asset, what is the amount we would spend for it? That is current cost. We could have a current cost accounting. Next is realizable value, which means that if today we sell the asset, that we have, what is the value that we would get for it? That would be the realizable value. And another method is the present value, which is nothing but the present value of future cash flows. What does that mean? Like in our example before, suppose I consider a 10% interest rate, it would actually mean that if 1 year from now I get 1100 rupees, the value of that, somebody tells me that he will give me 1100 rupees a year from now. So today when I consider its value, I do not consider it as 1100, I consider it as only 1000 rupees, because I know if I had 1000 rupees today, it would have grown to 1100. So the present value of future cash flow. This is the future. This is the amount I will get in future. Its present value is only 1000. To understand, we will just have a quick overview. We will take an example and understand in each of the scenarios what could be a historical cost, what is current cost, what is replacement cost, and what is the present value. Say, let's say X Limited purchased machinery in year 1 for rupees 5 lakh. He obtained a loan for rupees 3 lakh for this purchase. How will these be shown in the books at the end of year 5? At the end of year 5, machinery will be 5 lakh. Of course, there may be depreciation, that is not something we are considering. Machinery value, the cost, historical cost, actual cost. This is historical cost method. It would be valued at actual cost 5 lakh. And the loan was obtained for 3 lakh. Therefore, loan would be 3 lakh. This would be the position if we were considering historical cost. Measurement base, suppose we take current cost. Continuing with the same example, how will these be shown in the books at the end of year 5, assuming that the value of this machinery would be 8 lakh. Remember, the value of the machinery was 5 lakh. The cost was 5 lakh. But now they are saying that the value of this machinery would be 8 lakh if X Limited were to purchase it today. Also assuming that the loan was repayable in 8 years and there is a penalty for prepayment at the rate of 1%. So if it is current cost, what would we do? Current cost would say you value the machinery under current cost at the current cost of purchase. Therefore, machinery would be valued at 8 lakh. What about the loan? Loan, in case we were to repay the loan now, how much was the loan? The loan was for 3 lakh, right? 3 lakh. We would end up paying a penalty of 1%. Therefore, another 3,000. Therefore, the loan would be valued at 3,03,000. This would be the valuation of the asset machinery. This would be the valuation of loan if we were following current cost. Next, continuing with the same example, how will these be shown in the books at the end of year 5, assuming that the machinery can be sold for 3 lakh. So now we are talking of realizable value. The machinery can be sold for 3 lakh. So in this case, machinery value would be 3 lakh. It was a 3 lakh machinery. Cost was 5 lakh. Since this can be sold, realized only for 3 lakhs, it would be shown at 3 lakh value. Loan, the loan amount was also 3 lakh. Today also, the value of the loan would be 3 lakhs. Present value. Continuing with the same example, how will these be shown in the books at the end of year 5, assuming a discount rate of 10%? Discount rate of 10% every year. So the value is going to come down by 10% every year. Basically, it would mean that the machinery would be valued at, it was 5 lakh into 1 divided by 1.1 into 1 divided by 1.1 into 1 divided by 1.1 into 1 divided by for 5 years. Year 1, year 2, year 3, year 4 and year 5. This from a table, from a discounting table itself we would know would come to 0.621. This becomes the discounting factor at the end of year 1. Similarly, therefore, machinery would be 5 lakh into 0.621, which is equal to 3,10,500, and the loan would be 3 lakh into 0.621, which would give us 1,86,300. Now, this is actually a discount factor representing time value of money. What it means is that 0.621 is the value of rupee 1 at the end of 5 years at 10% discount. This, either we can multiply and arrive at this, or look at the discount factor tables and arrive at this figure. So we see that with different valuation basis, an asset and a liability may be expressed in a different manner. However, for our present computations, for all our accounting needs right now, all our study right now, we will stick to historical cost.